The number one factor that can dramatically change the housing market here in 2025 is if the Federal Reserve starts buying mortgage backed securities. Now, you've probably seen the headlines of the Federal Reserve dropping interest rates or raising interest rates or keeping interest rates the same. And most people think that directly translates into mortgage rates. Most people think that when the Federal Reserve drops their interest rate, that mortgage rates will drop. But we can see by this graph here that it's not the case. At the end of 2024, the Federal Reserve dropped their Fed funds rate 3 times. And after the Federal Reserve cut their Fed funds rate, we actually saw mortgage rates rise. So there's some correlation between the Fed funds rate and mortgage rates, but it's not directly correlated. But what is directly correlated is what the Federal Reserve does with their mortgage backed securities. Now, back in 2022, when the Federal Reserve started rolling off their balance sheet and releasing mortgage backed securities, I predicted that if they were to sell mortgage backed securities, we would see mortgage rates rise. And that's what the Federal Reserve has been doing, at least to some extent. They haven't directly sold mortgage backed securities into the market, but what they've been doing is as people pay down the principal of their mortgage, the balance that the Federal Reserve holds on their balance sheet, the balance of that mortgage starts to lower. So as people pay back their mortgage, as you make your monthly mortgage payment every month, the balance that the Federal Reserve holds on their balance sheet naturally lowers. And so I don't believe we're going to see the Federal Reserve sell their mortgage-backed securities, especially because they haven't done so within the past 3 years. I don't think they're going to start now as the economy is on shaky and uncertain ground. But what they might do if we experience some economic turmoil is they might start to purchase mortgage-backed securities again. Now, real quick, for those of you who don't know, what is a mortgage-backed security? When you purchase a property using a mortgage, that mortgage is then sold on the secondary market, combined with thousands of other mortgages. And then those mortgages, that package of thousands of mortgages, are sold together in what's called a mortgage-backed security. And now most people think that the Federal Reserve influences mortgage rates through their Fed funds rate, which there is some correlation, but what really dictates mortgage rates is the rate of return that investors are willing to get on their mortgage-backed securities. So if investors are willing to take a 7% rate of return on their mortgage-backed securities, then your mortgage rate will be 7%. Now, that's not quite exactly how the actual percentages work out, but it gives you a rough idea of how the mortgage-backed security market functions and why that directly impacts mortgage rates. However, what the Federal Reserve can do is they can bypass those investors. They can buy mortgage-backed securities themselves. And the Federal Reserve, they don't care about the return that they're getting on their investment. They don't care about whether they're getting a 7% rate or a 5% rate or even a 2% rate. And that's why rates dipped so low during COVID. The Federal Reserve bought a ton of mortgage-backed securities. In their own words, they bought enough mortgage-backed securities to keep the markets moving, which turned out to be about $700 billion worth of mortgage-backed securities. And right now, we're experiencing the longest runoff of mortgage-backed securities in the Federal Reserve's history. Now, the runoff is when, again, when people pay the mortgage, when you make your mortgage payment, part of that payment goes towards principal, which is paying down the loan against your home. Now, as you pay down that loan, the amount of debt that the Federal Reserve holds, the amount of money that's being owed back to the Federal Reserve decreases because they're the ones who hold mortgage-backed securities. And since we're experiencing the longest period of a runoff in the Federal Reserve's history, it's more and more likely that the Federal Reserve will pivot and start buying mortgage-backed securities. And I think if we experience economic turmoil here in 2025 and the Federal Reserve needs to restart the economy, needs to boost the housing market, what they're going to do is they're going to buy mortgage-backed securities. And that's going to drop interest rates. That's going to encourage people to both buy and sell, because a lot of people aren't selling right now because about 70% of all mortgages held by borrowers are at an interest rate of 4% or lower. So most people are not giving up that low interest rate. But if the Federal Reserve jumps back into the housing market, starts buying mortgage-backed securities, that could drop rates to 5%, 4%, or even lower. And we're going to go over some projections in this video of what the Federal Reserve projects mortgage rates could be, the high end range and the low end range for mortgage rates if they didn't buy mortgage-backed securities. And just to be clear, the Federal Reserve is not saying that they are going to buy mortgage-backed securities anytime soon. But if history starts to repeat itself and we experience any economic turmoil, I believe the Federal Reserve will U-turn. They'll start buying mortgage mortgage-backed securities, and that's going to drastically shape the housing market. And this is something almost nobody is talking about. This is something that home buyers, home sellers are not paying attention to. So if you understand this concept, you will have a great idea of when home prices are going to rise and fall, when mortgage rates are going to rise and fall, and you will have an advantage over your competition. So let's get right into this video here. But before we do, my name is Liam O'Reilly. I'm a realtor here in Vermont with Jerry Riley Real Estate. If you have any real estate needs, whether it's in Vermont or anywhere across the country, all of my contact information is in the description below. Reach out to me directly and I would be happy to help you. Okay. So we're going to jump over to the Federal Reserve's website to understand what they've been doing over the past few years and how that might change moving into the future. Okay, we are here at the New York Fed's website looking at their mortgage-backed security report that they came out with June of 2024. And we see here, basically, they talk about what they did over the past few years in this top section here. In 2022, the Fed began reducing the size of its securities portfolio in the open system market account, which is where they hold their mortgage-backed securities. And then in June of 2024, the Fed slowed the pace of the balance sheet runoff, reducing the monthly redemption cap on its treasuries while maintaining the monthly redemption cap on its agency securities. So in other words, they're shrinking the size of their overall balance sheet by letting mortgage-backed securities continue to run off at the pace that they have been, but starting to buy US treasuries more and more. So when we take a look here, this is what the Federal Reserve has done with their mortgage-backed securities. We see here, before 2008, they didn't hold any mortgage-backed securities. They didn't hold any mortgage debt. Then the great financial crisis happened. The Federal Reserve starts buying mortgage-backed securities. Then they start their first runoff. They let their balance sheet slowly run off until about 2012. At 2012, they start purchasing mortgage-backed securities again. You can see that's the rise in the chart. The increase in their balance sheet is the Federal Reserve buying mortgage-backed securities. Now, from about 2014 to 2017, they kept the balance of their mortgage-backed securities roughly the same. So what does this mean? This means they're still buying mortgage-backed securities, right? Because when you make a mortgage payment, part of that payment goes to principal. If somebody sells their home, they have to pay off their mortgage. All that principal gets repaid. So if the Federal Reserve didn't buy any mortgage-backed securities, we would see a runoff, just like we saw in 2017 after this level period of their balance sheet started to decrease and they started to run off the mortgage-backed securities, let the mortgage-backed securities run off their balance sheet. Then boom, 2020, COVID-19 happens. The economy shuts down. What does the Federal Reserve do? They start buying mortgage-backed securities. And the exact amount of mortgage-backed securities they state up here, it was about $700 billion worth of mortgage-backed securities. Right here, the plan was later amended to conduct purchases in amounts needed to support a smooth market functioning, resulting in total purchases of $700 billion of agency mortgage-backed securities within 2 months. That is this huge skyrocket in their balance sheet. They started buying mortgage-backed securities. They dropped mortgage rates, right? Mortgage rates likely would not have dropped to the levels that they did if the Federal Reserve didn't buy mortgage-backed securities. Then in 2022, they started obviously increasing their Fed funds rate. We saw those headlines throughout the country, but they also started letting their mortgage-backed securities run off. From 2017 roughly until about 2020, that took about 3 years of runoff, which is roughly where we are right now. And now there's economic turmoil. There's a lot of uncertainty around tariffs and a lot of uncertainty around the economy, employment, jobs, layoffs. And so the Federal Reserve, they can't just create jobs out of thin air, but what they can do is they can spark the housing industry by lowering mortgage-backed securities. They drop mortgage-backed securities, more people are going to refinance, more people are going to sell their home, more people are going to purchase their home. There's going to be an increase in new construction activity to meet that new demand caused by the lower mortgage rates. And so they don't directly create jobs. They don't directly pump money into the economy. But what they do, they lower mortgage rates, which causes all this economic activity and all this stimulus in the economy. That could be at some point in the near future if we experience economic turmoil. So yes, the Federal Reserve could drop their Fed funds rate, and that would likely impact mortgage rates as well, but not nearly as much as what we saw in 2019 or these other periods of time when the Federal Reserve was buying mortgage-backed securities. So what has the Fed been doing over the past 3 years? So basically, they put a cap on the amount that they want their balance sheet to run off. They don't want to flood the market with mortgage-backed securities. They want to make sure it's done in a controlled way so it doesn't send the housing market and the economy completely out of whack. So in 2022, they originally started running off their balance sheet at $17.5 billion worth of mortgage-backed securities each month. That's what they started with. That's this red line here. So yes, they let 17.5 billion run off, and then they had to purchase additional mortgage-backed securities to make sure that they didn't run off their balance sheet faster than what they anticipated, faster than what they wanted. After September of 2022, they increased the cap of their runoff from 17.5 billion to $35 billion per month worth of mortgage-backed securities. And we see here, we are nowhere near reaching that $35 billion per month cap. We've remained under that ever since the Federal Reserve set it in September of 2022, and we remain under it today. Now, the reason why we remain under it is because not many people are selling their properties, right? Home sales are at the lowest pace since 1995. There aren't many people giving up their 2% rates, their 3% rates, which are the majority of the holdings of the Federal Reserve. And there's not many people refinancing the properties to do construction projects on their home, basically refinancing, taking that equity out and using that equity, because most of these people that own homes where mortgages are held by the Federal Reserve, most of those people have a low interest rate. And we can see here at this next chart, what we're looking at here is the blue graph here. The blue lines are the holdings of the Federal Reserve. The Federal Reserve holds about 30% of all mortgage-backed securities in existence, which is a very significant portion of the market. And of those holdings, 90% of them are sub 4% mortgages. So most of the people who have mortgages that are sub 4%, they're not selling their home right now. They're not refinancing. They're keeping that low rate. And that's why the balance sheet hasn't run off past this $35 billion cap that the Federal Reserve has set. And we see here, this gives us a good snapshot of where all mortgages are held. We see here that about 70%, and they say it up here, in the MBS universe, which is essentially the mortgage-backed security market, all of the mortgages that are out there, 70% of the outstanding securities have coupons or interest rates less than 4%. And that's what we're seeing in this graph here today. Now, this next chart here, I think is a very interesting chart to look at. This is where the Federal Reserve projects mortgage rates to go over the next 10 years or so. So they see the median graph, this median projection, the baseline, is at around 5 to 5.5% stable for the next 10, 15 years, give or take. Now, this low rate scenario, in my opinion, that's the Federal Reserve cutting their Fed funds rate, but not buying mortgage-backed securities. They cut their Fed funds rate, that would lower mortgage rates to around 4%. And then this high rate scenario, that's if inflation starts to pick back up and the Federal Reserve can't cut their Fed funds rate. In my opinion, that's the least likely scenario out of this whole graph. So we see here that even if the Federal Reserve cuts their Fed funds rate, but they don't buy mortgage-backed securities, we aren't likely to see mortgage rates go much lower than 4%. At least that's what the Fed projects, and that's what I think as well. The Federal Reserve drops their Fed funds rate to zero, mortgage rates will probably sit around 4% because investors need to make a reasonable rate of return if they're going to give you money to buy a house. Now, we see here, this is the projection of the Federal Reserve's balance sheet over the next 10 years. And this is why I say the Federal Reserve is not planning on buying mortgage-backed securities in the near future. However, if history is going to repeat itself, we see here in this graph that when they have a runoff on their balance sheet, they have not been able to run it completely off. At some point, economic turmoil, economic uncertainty takes place, and they jump back into the housing market to stimulate the economy, to stimulate housing, and drop interest rates. Now, they're projecting that over the next 10 years, they won't have to do that, even under the low rate scenario, right? The low rate scenario, they're not increasing the size of their balance sheet. What these red lines are is more people paying off the principal. So if mortgage rates are down at that 4% rate, more people will sell their homes, more people will refinance, more of the mortgages that are held by the Federal Reserve will be paid back in full. And we see this steady decline of principal payments and the mortgage-backed security balance sheet that the Federal Reserve holds over the next 15 years. Again, this is what they're projecting. But if we look at that graph up above, it's not very likely to happen. So why do I say that this is the number one indicator? Well, if the Federal Reserve starts buying mortgage-backed securities, that's when we can see a drastic and quick shift in mortgage rates, which would significantly change the overall housing market. Again, I think there's at least some chance of that happening in 2025 with all the uncertainty around tariffs, around layoffs, around unemployment. And if you're paying attention to this and you see the Federal Reserve talk about buying mortgage-backed securities or even start to purchase mortgage-backed securities, you'll know that's a good time to jump into the housing market, or that things in the housing market are about to heat up, right? If you're on the sales side, you might want to wait a little while for those rates to actually drop and buyers to flood into the market. If you're on the buy side, you would want to get ahead of it, purchase sooner rather than later, so that you don't have the frenzy of people competing against you for the limited supply out there in the market. Thank you guys so much for watching. I really appreciate your support. Leave me a comment. Let me know what you think, and I'll see you in the next video.